If you are wondering where to find value in today's market, there's no better person to point you in the right direction than the Dean of Valuation. Aswath Damodaran is a finance professor at NYU's Stern School of Business. He joins us now from San Diego. Aswath, great to see you. We've been having a fierce debate on this desk in terms of NVDA. I know that's an area that you like, but overall in the markets, what sort of valuation metrics do you use? Because so many people come on and say PEs have been compressed, forward PEs have been compressed. What do you look at?
I look at a forward-looking number called the equity risk premium. Basically, I back out from stock prices and cash flows what investors are expecting to make. And at the end of 2018, that number was close to 6%. There have been only 3 years in the last 55 where you've had a higher number. One was in 1979, the other was at the end of 2008, and the third was in 2011. If you look at the cash flows and the level of interest rates today, stocks look more likely to be undervalued than overvalued. That said, though, I think the big concern for the coming year is going to be expected growth. So the earnings reports for the next 2 quarters are going to be key in whether stocks can sustain themselves. I think if you can go through the first 2 quarters without major shocks to earnings, I think the market is poised to recover. So
basically, even though the market seems, according to these metrics, like the market is undervalued or more likely to be undervalued than overvalued or fairly valued, it's still a wait-and-see market for the first half of the year.
Because I think growth has come down substantially. Yeah. I mean, expectations have come down so much over the last year. The question is whether we've adjusted enough or whether there's more to go. There might be more shocks along the way that bring growth down even further. But at the moment, given what people are expecting, and even in terms of lower growth, I'd be more likely to buy stocks and sell them.
Okay, be the tiebreaker on our debate on NVIDIA and whether or not it's value in this market. And it doesn't have to be a comment on this individual stock, but I know that you like tech stocks in general and see value there.
I did buy NVIDIA at the end of last year because it's a stock that's been on my radar for a long time, but not at the prices it was trading at. My limit buy came in at 145. I'm still waiting to get back to 145. I might never get there. But I like the company. I mean, I think there is a real chance that growth could drop off next year, but I think long term, I would still buy the growth in that stock at the prices that you get them for today. I also like Boeing. I mean, I think it's a stock that got punished for all the wrong reasons when the China proms popped up. But, you know, let's face it, you can substitute for Apple. You can't easily substitute for Boeing. So I don't think you can tar all these companies which have China exposures with the same brush.
So the two broad categories of value in this market, in your view, Aswath, are beaten up tech stocks and companies exposed to China. And what really caught my attention is that you even like General Electric, which is sort of, I mean, it has China exposure, but it's also a story in and of itself in terms of being a turnaround story.
You know, GE has been so beaten up that at this stage, if the management can chew gum and walk at the same time, people are going to think they're geniuses. So I think it's a stock that I'm buying because people just don't expect it to do much. But I think it still has some solid businesses that if it plays its cards right, I think you could see a significant recovery in the stock.
But Professor, is it cheap? Is there value there? I've tried to make the argument that there's a sum of the parts argument. So is that what you want to do, or do you just think it's about chewing gum and walking?
I think in a sense the quality of the management is in how easily they can disentangle the parts. So on a sum of the parts basis, GE looks undervalued. But it's very difficult to break up the parts because they're all connected to each other. You need a pretty solid management team to be able to separate the parts and to be able to get the best prices you can for each part. That is going to be the test for management, is whether they can do that. This is not a turnaround story. This is a story of disentangling a company and selling off its pieces for the best prices they can get.
Professor, thanks so much for joining us. Always a pleasure speaking with you. Aswath Damodaran of NYU. Next time, if I see Larry Culp, I'll see if he can walk and chew gum at the same time. I didn't know that was such a